It's like the first step of a back test is we just trade it with no commission, no slippage, no fees, no stop loss, and profit take, because that proves that there's edge there. Now, once we've proven that there's edge there, we can go through an iteration of how do we capture this edge efficiently through our mechanics and, our assumptions of slippage. Once we add those, it's still worth doing.
Perfect. Yeah, that makes sense. So like this is like, all right, the first time you run it without that, because he was showing that in the video. He's like, I'm going to explain this to you what it looks like without it. And then he added it to it, and it shows like, oh, this, like you said, you run it without it. All right, this looks like it might be one. Let's see what it actually looks like when we put it into play, and you add all the miscellaneous things. And this is like a more like, here's like basically like the play in football practice. It's like drawn up, and then you run the play, and this is what it might actually look like.
Yeah. And the other thing to that too is this all comes into like theory and practice, and that's kind of like the fragility of it. So if you were to just sell like a 15-cent option with no commission, no slippage and fees, you're going to look like you're a billionaire. However, to get into that position, because even in the SPX, it's very liquid. So there's a lot of people trying to buy and sell contracts. To get in when they shop that between the bid ask, it will be between like 10 and 15 cents. So if you're selling 15-cent options, you can lose 50% of your profit just getting in. So that's why like we're normally selling $1, $2. We're not messing with those things, because if we get 5 cents extra slippage on getting out or 5 cents extra slippage getting in, that takes 50% of our profit. You know what I'm saying?
Makes sense. All right.
So those are like theories and practice thing. That's part of it. But that's like, again, IV minus RV, implied vol minus RV. So that's like, is there edge? Can we make money off this? And then it's basically anything we sell, especially on the put side, is going to pass that first equation. Then the real question is, how do we efficiently go about doing this?
All right.
And that's kind of the iteration we're going to go through. And then the thing we'll do as well with that is it's like, okay, if we can, like, if we're only selling a put, for example, like it doesn't take any buying power to sell the call, because we still have the same risk. We just take it on both sides. So then if that call just increases our max recoverable risk and has a positive expected value of like $2, it probably makes sense to sell it. So this is the iteration we'll go through, is like single test, adding to that test, optimizing to that test, putting it in a portfolio.
Perfect.
Yeah.
Perfect. Makes sense. And to kind of dive deeper, just to make sure I'm on the right path on slippage, entry slippage, like, for instance, I think, this was diving into exit slippage. So exit slippage only exits when there's profit. So like, so if you have your profit mark at like $1, like if you put 0.5 in at exit slippage, it's only going to, it doesn't mean you're just going to be exiting at 0.5. It might be like 1.5 if you put 0.5 in, because it's waiting until you hit your profit.
Yeah. So what the back tester does is when it hits that mid price, which is if your profit is, let's say your profit's $1.20, when there's a bid of 115 and there's an ask of 125, you hit 120. So then basically what that'll say is that you ended up actually selling it for $1.15 because you got filled at the bid. Right. However, that exit slippage, because again, IV minus RV minus commission, slippage, and fees, is we will most likely only be using a stop loss, because if we use a stop loss and a profit take, all of a sudden we've just doubled our entry slippage. You know what I'm saying? So like now we've created a structure that makes it more difficult to capture that edge.
All right.
So yes, that is correct, but we will only use that function. Like if we traded a 1 day to expiration and we wanted to get out before the market closed, we would have exit slippage. And if we use a profit take, we would do that to get exit slippage. But in general, anything that we trade that's like $1, $2, $3, we're just not going to be using a profit take, because it's just going to eat too much of our profit.
Right. All right. That makes sense. So only use stop slippage, stop loss slippage to help us be more profitable, basically.
Correct. And also when we think about that too, is like entry slippage is going to be less, because if the market moves really fast when we're trying to enter, we just resubmit the order. We don't have risk because we haven't entered the position in yet. But like our stop loss slippage, because every dollar it goes past our stop loss is money we lose, and we want to cap a risk, we're willing to pay more to get out of that. You know what I'm saying? So, and also we're the market taker. So like if the market rips down, our order's already in, we're just going to take whatever that environment may be, and we'll probably have to pay more to do that. Whereas when we're getting into the market, we're the market basically maker, like we're coming into it. Like
I'm going to pay less.
Pay this much to take on this risk. And if the price changes, be like, I want to change that. So that's kind of like another way to look at it. And also, like if we're selling a $1 put option, we're only shopping $1 to, you know, $1.05, $1.10 on that bid ask. But if we have a $1 put option, we have a stop loss at 4x, that means we've already lost $400, so the option's at $500. So when we're trying to buy back a $500 option, that bid ask could be between $5 and $5.45. So we would obviously, even if the percentage is the same, we would pay more to do that. So exit slippages or stop loss slippage will always be more than the entry slippage. And then I'm not sure if you noticed this, but in Options Omega, it says cap, stop loss at value, cap, profit take at value. Have you seen that?
No, I haven't noticed that yet.
So under MISC, you're always going to want to have those checks, because that basically what that does is whatever price you said your stop was going to be, it just takes that price and then adds whatever your slippage was.
So always check cap what?
Cap operating losses at stop loss, cap operating losses at profit take. And then again, we probably won't be using very minute profit takes, but we want to make the game harder than it is than in person. So like if we're using a profit take, we're going to click require 2 consecutive hits for profit take. So that means 2 consecutive minutes. It would have had to have our bid ask value. So that creates a high degree of certainty that we would have filled. And then for a stop loss, we do not check have 2 hit, because the second it hits, we want to be like, you know, sometimes we may not get out of that, but we're just going to try to get out, you know?
Makes sense. You just want to try to get out as fast as possible, basically, so you can stop losing money.
Yeah. And also, like, it's creating a rosier picture if we require it to hit our stop loss 2 consecutive minutes. Whereas in real life, we're probably just getting out on the first minute. But for a profit take, we, you know, want to make it harder.
All right. And in that profit take, because it's like, for you said 2 consecutive minutes, would it also allow you to have chance for higher profit too, like the longer you stay in it? Or
yeah, but
anything to do with it or not really?
Yeah, when you click the profit take, that means that the bot would have an order trying to buy that back in the market. So we could potentially get filled at like 5 or 10 more, but we're not going to count that because that's just a rosier picture. Like we know we're going to get what we bought when we have 2 consecutive profit takes. We have exit slippage, and you know, it's just all more conservative. So like all these back tests, we're basically going to outperform. The reason I beat them up like this is because, like, if the market moves really fast, we may get 1 day every 3 months where we have like 4 times the amount of slippage. So when that happens, it just gets factored into our 40 occurrences, and we're still below what the back test was expected.
All right.